Okay, so in the last video, I introduced you to the concept of a line of credit. And since we hit the common goal for the video, I'm bringing you a deep dive into the home equity line of credit, or the HELOC. As we spoke about, this is a revolving debt instrument that allows you to, borrow as much as you need from a set limit, use it, repay it, borrow it again, and only pay interest on the amount that you used. This interest is usually a variable interest rate, which is different than the primary mortgage, where you can choose between a set limit and that variable rate. Now, with a home equity line of credit, there are two distinct periods. The first one is the draw period, which lasts about 5 to 10 years. This is where you can do your borrowing, you're repaying, but mostly, borrowing the funds. After this is up, you head into the repayment period, which is between 10 to 20 years. Your line of credit freezes here and you can't borrow any more funds. You are stuck having to make periodic repayments, which are amortized or spread out between within the life of that repayment period. Now, in a home equity line of credit, you are pledging your home equity as the collateral to secure the transaction. What home equity is, just basically how much of your house that you actually own. So if you just, paid cash straight up for your house, your home equity would be the market value of your house. But in most cases, people have a mortgage, so your home equity would be the amount, or the market value of your house minus the amount outstanding of your mortgage. Now, is my home equity, is that amount the dollar limit that I have in my home equity line of credit? Well, not exactly. You need to figure out what's called the loan to value, or LTV. That is the percentage of your home equity that you have available to you in your HELOC. There are different ways that you can go about this. So if your mortgage is not really a factor or it's very low, your max dollar limit in your HELOC would be up to 65% of your home equity. However, if you have a mortgage that's prevalent, or there's still a good amount to pay off on it, your mortgage balance plus your dollar limit for your HELOC can't exceed 80% of your home value. So let's say you have $1 million house, 80% of that is $800,000. Let's say you have $200,000 still on your mortgage, so your dollar limit for your HELOC would only be $600,000. Now, you can't just slap on a value to your house. You're going to have to get that professionally appraised, which you can do from multiple different appraisers, and then take the highest value to maximize the amount of space that you have in your HELOC. You might also have to deal with a little bit of legal costs in terms of setting up the account, insurance, etc. And then another thing that you have to consider is whether you're working with a standalone HELOC or a readvanceable HELOC. So readvanceable would be when you combine your HELOC with your primary mortgage, in the sense that they're worked into the same contract. Now, the advantage of this is you're dealing with just one lender, and the more that you pay off your mortgage, the more your dollar limit for your HELOC actually increases. This is different than a standalone, which is independent of your other mortgage, if any, where your standalone dollar limit would just be a set amount. But the standalones are easier to set up, less fees than a readvanceable. So other general requirements include 35% equity as the minimum that you have to have in your house if it's a standalone HELOC that you're looking to open. Readvanceable, that number drops down to 20%. So you have this great tool that you can use for multiple purposes, including just having an emergency fund, having that amount available to you, or debt consolidation. So let's say you have credit card debt here, student loan debt there, etc., you can pay all of those off with your HELOC, which might have lower interest rates than your 22% credit card, and now all your debt is in one spot as opposed to more spread out. That is a great tool that you have access to, but you also have to consider the risks associated with it, and there's a big one. Lose house. So if you keep on borrowing and borrowing, you may find yourself in a situation where once the repayment period rolls along, you find yourself unable to make those payments. You don't have the money. You're going to receive what's called a notice of sale from your lender as kind of a final warning to say, hey, if you don't make these payments by this date, we're going to take your house and sell it, what's called a foreclosure, so that we could recoup our gains that we've lost from lending you this money. Not good. Another thing that might not have immediate effects is that if you're borrowing and borrowing and borrowing, your debt's going up on your house, which makes your home equity go down. Let's say in this scenario, the real estate market's not doing well and your house value actually drops. That would make the amount that you owe on your house larger than what it's actually worth. This is called being underwater. And nothing would actually happen. You could just continue to pay off your debt and rebuild your equity. However, if you are underwater and you need to sell your house, you need to move, you won't be able to make any money. In fact, you'll actually lose money by selling your house because you owe more on it than it's actually worth. So that is everything you need to know about the home equity line of credit. Hope you enjoyed. Let me know what you want to learn about next in the comments.